did that. Eben, we're going to put your slides up and we're going to drive it from outside.
Thank you, Eugene. Thanks for the opportunity and welcome, everybody. Thanks for your time. So amidst this lot of noise going on with the Middle East conflict, we also have a sea change happening in the US. In a week's time, we've got a new Fed, for all arguments and purposes, convening. Or the question is, will we have a new Fed when Kevin Warsh takes the new chair? Now, a lot of the comments we will make are based on his public comments during his confirmation hearing, what he has written in the past, and what he has written also with Scott Bessent, who is the Treasury Secretary. And one of the things is Kevin Warsh is obviously not new to the Fed. He's been a member of the FOMC before, but he's been very critical of the Fed. And we're going to talk through some of that. So if we skip to the next slide, please, Olga. He is the new sheriff in town. And a number of people asked the question, well, it's one person. So what can one person do? Now, the outgoing chair, before he was the chair in 2016, made the comment that there's a single FOMC participant who has most of the leverage in our policy discussions. Observers would be well advised to listen carefully to what she says, with reference to Janet Yellen, who was the chairperson at the time. Now, some of the changes that Kevin Warsh has said that he wants to make are things that we've become used to over the last basically 2 decades. Those pertain to forward guidance, which is a powerful tool where the Fed says, this is what we want to do, this is what we're going to be doing. The balance sheet, obviously, which has been a big debate, the size of the balance sheet, as well as the bank reserves that it provides, and the function that it provides in the economy. Also, what Kevin Warsh has said is that he doesn't like the way that the Fed communicates. Now, interestingly enough, what Chair Powell also said was the comment there at the top in November 2016. In my view, the public expression of our diverse views sustained public support for the Federal Reserve as a public institution. And members of the public who disagree with our policy should know that their concerns are given voice in our deliberations. That's a powerful message for any central bank, basically to say that, look, you need to rope the public in and make them understand what we're going to be doing. Kevin Warsh has also said that he disagrees with the way that inflation, for example, is calculated, and a couple of other things. Now, what we want to do is just to talk through some of this. So just as a reminder, if we skip to the next slide, the Fed's mandate is basically to have maximum employment and price stability, and as well as moderate long-term interest rates. Now, in their consensus statement, the Fed then basically agreed that price stability means that we've got the year-on-year change in the personal consumption expenditure index. We have that at 2%. Now, what I show here is just the PCE index without energy and food. And you can see here, the first problem that we've got is the Fed has been above their target for basically the better part of 5 years. So this raises the concern that, look, we've set a target, we firmly believe it, we're guiding that we're going back there. There's been a number of events, but we're not at the target. And it seems that we're not getting back to that anytime soon. In fact, given what's going on in the Middle East, inflation has headed up. And it seems that there's something the whole time. Inflation keeps on going up. Last year, it was the tariffs. Before that, it was used cars. And it carries on. There's something the whole time. Towards the end of last year, there were all kinds of pressures to get interest rates lower. And some of that was on the back of the job market actually seemingly weakening. Now, on the next slide, we basically show the unemployment rate in the US, as well as the natural rate of unemployment. Olga, if we just skip to the next slide, please. Sorry. Thank you. So here you can actually see that unemployment is held up fairly stably, and we're basically at the trend as determined by the Congressional Budget Office. So at this point in time, it means that the Fed's actually going to have to pay special attention to the inflation side of their mandate. So let's just look at inflation and its effect on us or on the population in the next slide. So what I've done here is to just look at purchasing power in the US per decade. Now, the dark line towards the middle of the graph basically shows that for this decade, now we've still got 4 years to go, remember, we have lost purchasing power to the extent of 24.5%. So with the exception of the three lines at the bottom, which represent the 1940s, the 1970s, and the 1980s, most people don't know what's going on. They actually are much poorer as a function of inflation, and it explains a lot of the unhappiness that you see. And I'll come back to that in a slide. On the next slide, though, we ask the question, what do markets actually think of this? Now, the top line that I show there basically gives you the 10-year US Treasury rate. The bottom of the graph shows you the inflation-linked rate, so the real rate. And then the difference between the two actually gives us the market-based expectation of inflation, the so-called break-even inflation rate. Now, the interesting thing here is that if you look at the market-based inflation expectations, that almost looks like a stable anchored line. The Fed loves this word that inflation expectations are anchored. And if you actually look at the market, the bond market, it would appear that inflation expectations are anchored. You see that what has been doing the hard work here are real rates. Real rates have been pushing higher, and some of that's amidst fiscal concerns, but the inflation expectations seem to be contained. On the next slide, though, we actually asked the question what the public thinks of this. Now, one of the survey-based expectations that's been around for quite a while and very popular and very academically rigorous is the University of Michigan inflation expectations. Now, this actually shows a very interesting picture. The dark line at the bottom of the graph is the median-based expectation. That's what we normally see. Now, the concern there is you can see over time that line has been fairly stable. Of late, it has moved higher. The red line that I show there is a big concern, though, because what that shows is the average expectations. This is measured distributionally, and what you can see here, I also show the band. The brown lines there is the 25th percentile and the 75th percentile of the distribution. Now this distribution has become bigger, wider, and you can see if you look at the average there, I don't call this anchored. So the market is saying inflation expectations are anchored. If you look at public expectations, there's no stretch of the imagination that you can call this anchored. If I look at the next slide then, for interest sake, on the left-hand side, you always need to distrust two-sided economic and graphs, but still, on the left-hand side of the graph, I show the University of Michigan Sentiment Index, and that has fallen through the floor of late. Sentiment has been very bad. On the right-hand side, what I show is the so-called misery index. Now, the misery index is just basically the unemployment plus the inflation rate. But what I do here is I actually use the average inflation expectations. So you can see that this misery that people are feeling is largely driven here by the average inflation expectations. Obviously, if you use another measure of the unemployment rate, like the underemployment rate, you get even more of this misery that we experience. So the reality is that inflation expectations are not as anchored as we probably want them to be. If the Fed actually creates some noise here by saying we need to make changes to the way that we look at inflation, we're talking less to the public, you're actually starting to make these things even more unanchored, and you're risking your stability here and your credibility. If we actually slip to the next slide. What does this mean then for us in the market? So what I look at here in the next slide is just what we've seen in the last couple of weeks is, if we look at the total return between correlation between total returns of stocks and bonds, we actually see that total returns have been very correlated. So with other words, at the moment, if I look at bonds and I look at stocks, they almost the same thing from a correlation perspective. Now that's not a desirable feature, because in portfolios we buy bonds and stocks, but we yearn for the correlation. Now you could look at this slide and say, oh, they're so highly correlated at the moment. You could actually use that as a trading signal because it can only get better. What I do in the next slide, though, is I show the longer term picture, and this is a concern. So what we do is we look at the core PCE year-on-year change that we looked at earlier. We break that down in deciles, and we take the median per the decile, and then we look at the same time at what the correlation, longer-term correlation between stocks and bonds were, conditional on being in that decile. And this shows us an interesting picture. When inflation is below 2%, we actually have a very desirable negative correlation between stocks and bonds. However, if correlation is where we have it at the moment or higher, we have a very distinct pattern that the correlation moves higher. With other words, on a portfolio basis, the stock bond correlation deteriorates and it becomes less desirable to hold bonds relative to stocks. Just to give you a sense of what that means, if you take a 60-40 stock bond portfolio, for example, with a 20% volatility for stocks, 10% for bonds, and you've got correlation at minus 25%, that if you then move correlation to minus 5%, means that on a relative basis, your volatility of the portfolio changes by about 10%, which is quite significant. So that means to achieve the same thing, you either need to say the same returns, you either need to sacrifice some of your risk objectives, or you need to be satisfied that you're actually not going to achieve the same returns. With other words, it has a risk budget effect. So in conclusion, then the last slide, so what? Next week is a meeting. There's a lot of moving parts with the FOMC meeting. It's certainly going to be interesting to get guidance out of that. It really is time to change the narrative and ask the question of whether US inflation expectations are actually anchored. What is going to be important is what the Fed says and how their communication strategy is built around the changes that they are going to be making. What is important for us, though, is that in this regime, in this inflation regime that we're experiencing at the moment, bonds behave more like equities. So we've got less diversification, and it means that you have that the decision between bonds and equities become more of a trading decision than a longer-term portfolio allocation decision. So with other words, expect more volatility, and risk evaluation is central to your whole process. And asset allocation in this environment cannot be static. Just on the local side, we prefer domestic duration, with other words, longer-term bonds to US bonds at this point in time, given the fiscal situation and given this type of uncertainty. However, if you do have that US bonds reprice, it puts pressure on bonds through the rest of the globe. Thank you very much.
Eben, thank you very much. A couple of very interesting thoughts there. I think a lot of, well, some of the comments that we've seen on Kevin coming into the Fed, among other things, and I'm going to come back to inflation and interest rates and your views on that. But more specifically is US debt, because that's a going concern. You know, the debt levels are increasing, and with global growth slowing, you know, there seems to be a lot of thought on the US going into a stagflationary type of environment. Your thoughts on Kevin and how we could potentially tackle US debt, because inflation in the short term is maybe not a bad thing from a debt perspective, because it erodes your debt, but that leads to a whole bunch of other problems. How do you think it's going to tackle the US debt issue?
Yeah, it's an excellent question, Eugene. So we expect that there will be a new accord between the Fed and the Treasury. This dates back to the same type of accord that you had after World War II. Now, Scott Bessent and Kevin Warsh are very close. So they have jointly criticized the Fed and the balance sheet over a period of time. They share very similar roots. So I do expect that there's going to be closer collaboration between them. If you actually think at the moment, for example, the Treasury Borrowing Advisory Committee has recently agreed that the Treasury can start doing repos, for example. Now, what that means is that at the moment, the Fed carries the Treasury General Account. That's where the Treasury basically banks with the Fed. And one of the reasons the Fed has been growing their balance sheet is to maintain liquidity. What the Treasury is now saying is we can do some of this ourselves. So expect some changes that might challenge our thinking and our understanding of the way going forward, which will be a way to shrink the balance sheet. At the same time, if you shrink the balance sheet, you put pressure on rates upwards. But they have also been starting to buy shorter dated debt. And we've seen in the US, for example, money market funds are sitting with around about $7 trillion at the moment. And you know they buy TBs, for example. So the reality is there's a lot of demand for shorter dated debt. If you start tampering with interest rates, though, and you force them lower, that creates a concern because your marginal buyer is not going to be necessarily that happy to hold on to that. So it's an interesting time, and I think you can easily, this is your point, you can easily here create a disequilibrium. So that's the concern we've got. It feels that US debt is under pressure, and you know the inflation situation is not appropriately managed, or it can become unhinged.
Exactly that. And I mean, you know, a lot of what's happening on inflation is hinging around